Hi, welcome to another episode of NGWA's podcast series, Industry Connected. Today, we're going to speak with Jerry Colletti, who's an investment broker and portfolio manager with the Morgan Stanley Group. Jerry first got started in the business in 1980, so he brings a wealth of knowledge, experience, and expertise to the discussion. But today's topic is really going to be geared towards the novice or the intermediate investor. He's going to focus on the market volatility, thoughts and ideas on how to plan for retirement, as well as how to do your proper due diligence and selecting a financial advisor to work with. So I hope you find this information helpful and you can apply it to your everyday real world situation. Okay, well, welcome today. My guest speaker is Jerry Colletti. He's the first vice president with Morgan Stanley Group. Looks like Jerry started in the industry back in 1980 with the Salomon Brothers. And since 1992, he's been with the Morgan Stanley Investment Group within the wealth management division at Morgan Stanley. So before we get started, I do have a disclosure statement that I need to read for everyone, and I'm going to post it here on the screen. So the Morgan Stanley disclosure statement. The views expressed herein are those of Jerry Colletti and do not necessarily reflect the views of Morgan Stanley Wealth Management or its affiliates. All opinions are subject to change without notice. Neither the information provided nor any opinion expressed constitutes a solicitation for the purpose or purchase or sale of any security. Past performance is no guarantee of future results. The investments discussed may not be appropriate for all investors. Morgan Stanley Smith Barney LLC recommends that investors independently evaluate particular investments and encourages investors to seek the advice of a financial advisor. The appropriateness of a particular investment will depend upon an investor's individual circumstances and objectives. All right, Jerry, are you good to go?
Yes, I am, Terry. How you doing today?
Good. How about you?
I'm good. That disclosure statement, very interesting, because I had talked to our compliance people and I said, look, I'm going to be on a podcast. Is it okay, guys? They said, sure, it's fine. And then like 10 minutes later, I get this email. That disclosure has to be read. So,
hey, it's the world of
either
CYA.
it's me or it's standard with the firm. I don't know.
Yeah, well, good. Well, I'm glad you took time out of your busy day. I know the market's just open, so we won't spend too much time. I know you got to get back, but you know, with the craziness of the markets right now, and the reason why I wanted to ask you to come on and share some thoughts. What's your take on, one day the market's up, next day it's down. It's just a roller coaster. And so what's going on? What are the investors or what's Wall Street looking for?
Well, I'm looking at my screen right now. The Dow's up 430 points, right? Based on this Gilead information this morning that one of their products may have a solution for the virus. My opinion about what's happening now, and it's unfair for the average investor, unfortunately, because it's really hard to keep pace with something like this. This is unique. It's a little different than 2008, and it's moving very rapidly. I mean, the market. The Dow hit a high of 29,000 back in February. Went down as low as 18,000 and change in March, March 20 something. And now here we are back up. So it's moving real fast, too fast for the average person to deal with. What we're dealing with here now is really, we just patiently have to wait for this virus and this vaccine. I think the market's a little ahead of itself right now. Okay. I would expect to see action like this if it was announced this morning that we do in fact have a vaccine, but we don't yet. Right. And the only reason the new cases are dropping throughout the country is the social distancing. We're not sure what's going to happen once the various states reopen. But clearly there are parts of the economy that are going to be affected significantly, regardless of whether or not the vaccine happens soon or later. Yeah. Restaurant industry, gambling, airlines, hotels, movie theaters, sporting events. It's going to take a long time for these industries to recuperate and it reflected in the company's earnings.
Yeah. So,
So I think we're a little ahead of ourselves.
okay. So talking about these businesses are being affected. So we had the federal stimulus package, and how do you see that playing in right now? Potentially helping some businesses, stabilizing some things, possibly. I don't know. And then long term, with all this money and inflation, how's that play out, you think?
Well, if you compare, you go back to 2008, because that wasn't too long ago, and that was just a nightmare, right? And the Fed learned quite a bit. I mean, we went through several quantitative easing programs. The event happened in 2008. It really wasn't until 2011 that the market started to kick in and start to repair itself. So what's interesting this time around is the Federal Reserve, I think, is taking everything they learned in 2008 and they apply it. They applied it to this situation. They did it very quickly. They jumped on this situation. They performed admirably. Whenever there was a breakdown in the markets, they fixed it. They covered it. We have a form of QE happening now. We have also other programs in place. So the Fed was ahead, even though it happened quickly and they had to act quickly. I think they were prepared to do that, and they did that. So I was okay with that.
So how will this influx of money affect the market long term?
Well, you know what? Before this event happened, I was just starting to breathe a sigh of relief since 2008, just recently, to be honest with you.
Yeah.
And what I mean by that was I started to see finally legitimate wage gains. I'm on a subway, it's crowded. I'm on a train, it's crowded. I'm in traffic, it's crowded. Vacations are hard to book. Yeah. It was nice to start to see that, and it took a decade to see it. Now, the other side of the coin, though, is it comes with a cost. It comes with a price. This monetary and fiscal stimulus we see right now is going to affect us down the road. How far down the road, I can't tell. But our national, we started this off at 23 trillion. Our national debt, it's now at 27 trillion.
Yeah.
The last time I read data, the U.S. Treasury collects about 3.5 trillion. Our government spends 4.5 trillion.
Okay.
You roll forward to, let's say, 4 or 5 years down the road, we're going to be 30 trillion in debt. The cost of servicing that debt, the interest, is going to it's going to take 50% of what we earn to service the debt alone. So we have, and this is something that has bothered me for a long time. We got out of these jams in a different way, not through organic growth, but through monetary and fiscal stimulus. So down the road, sometime we've got to address these issues. Now, going into this, we had what people termed the everything bubble. Well, the everything bubble basically got pricked by the coronavirus. Yeah. And now we are going to create maybe something even bigger than the everything bubble. So it's going to be interesting down the road, see what happens. But there's a danger there for investors and people that are retiring in the next couple of years. You have to be very careful.
So what recommendations would you have for someone? I guess put them in two buckets. Someone who's just new into, maybe they're younger, getting into the market or starting their retirement, and then the individuals who are within a few years or within a decade of retiring. How do you look at this situation for those two different?
Well, those young people that still want, it's funny, the millennials, right? The criticism of them was they didn't want to take on any debt. They saw their parents take on debt. Yeah. They saw their parents participate in the stock market and got beat up a little bit. But if you've got a long-term horizon, you're clearly going to invest in companies in the United States, and preferably the strongest companies, you have to basically believe that technology is going to move this country forward in a big way, in a very powerful way. I mean, it's just the technological revolution we're experiencing. It's just amazing. So things are going to be better long term, clearly. Now, if you are later on in your years and you've got to call it quits, and you can't, you're no longer getting 1099 income, W-2 income. Look, you're living off of a pension, hopefully, Social Security, and you're living off of the return your invested assets, your savings will get you. And you got to be very careful in the market right now, because in 2008, those people that had a 5-year retirement, they were going out in 5 years, they got hurt. It hurt them badly.
Right.
You take this situation, I mean, going into this morning, the market was down 15%. So they're going to be hurt too. Those people that were calling it quits in a couple of years.
Right.
So hopefully they were positioned to offset that.
Well, let's take the sort of the not so secured situation. Individuals who don't have pensions, maybe all they have right now currently is their own retirement account of 401k, and they're 5 years out, 10 years out. What advice would you give to them?
Well, you know what? Clearly, pretty much Wall Street talks to clients every day about this. I mean, I talk to my clients about this every day, and a lot of the times it goes through one ear and out the other, unfortunately. But what you have to, you want to get as close to a crystal ball as possible into your financial future. Mm-hmm. And right now there are tools available on Wall Street that will tell you what you're going to look like financially 10 years from now, 20 years from now. Can't tell you what you're going to look like cosmetically, but we're going to tell you what you're going to look like financially. And everybody needs to understand, if you're going to retire in 5 years, what is your income? Add it up. Pension, Social Security, and the earnings on your investments. Now, that doesn't always guarantee success, okay? You go back in time, you got people in retirement communities in Arizona and Florida that sat with a financial planner, and they said, okay, here's your pension, this is what it's going to give you, here's your Social Security, and that 50,000, 100,000, 200,000 you have saved, it's going to earn you 7%. Well, guess what? Due to certain situations that occurred in 2008, people aren't getting 7% on bonds anymore. Yeah. And save money. So you're talking about a portion of their savings and a portion of that equation now disrupted and messing, and people's incomes aren't what they anticipated it to be. So you could have situations like that going forward, but you got to do the best you can to see what you look like financially down the road.
So I mean, the obvious one, people invested in stocks, but what are some other vehicles that maybe you've seen that are overlooked, that aren't as well known or commonly spoken about in the media, or just amongst individuals?
Well, if you compare investing to what it was years ago, there's so much more opportunity to invest in markets right now. All right. So you got individual stocks, individual bonds. You have exchange traded funds, which are basically portfolios of stocks or bonds that trade like a stock on the stock exchanges. You have in those exchange traded funds that basically you can get them benched off of indices. You can get them benched in sectors, in industries. There's right now when you look at the market today, I see airline stocks up. Now, airline stocks got crushed over the last month. Okay.
Yeah.
All right. So you have a choice as an investor. You can buy an airline, a particular airline, United Airlines, American Airlines, Southwest Airlines, or you can buy an ETF that owns all the airlines. So what's nice about what's happening in the markets today, just through financial engineering, there is so much more to invest in that an individual can manage their portfolio in a very sophisticated way. It's just not buying a fund, holding on to it for 10 years, keeping your fingers crossed. You can actively trade in a market, and you can actively try to figure out what industries are going to do better than others over time. So again, individual stocks, ETFs, regular mutual funds, things like that, people can use.
Okay. Now, I guess as people approach a little bit more towards retirement, is there, in your opinion, I guess a way to, I guess, diversify your investment? Do you make a recommendation of how much you should maintain being liquid versus conservative versus riskier stocks? Assuming that, someone's 10 years out and who knows what the next 10 years hold, another pandemic, another market. I mean, we had stuff happen in 2001, obviously, with the World Trade Center, then again 2008, and here we are 2020 with the pandemic. So if someone's looking 5, 10, 15 years out from retirement, how should they, in general terms, look at risk versus conservative investments?
Well, let's exclude situations like this, a virus, okay? All right, because that's just a different situation, and it's almost like an act of God type of situation.
Yeah.
But going forward, interest rates in this country. I remember my cousin calling me up back in 1980. He was celebrating. He had just purchased his house. I said, Tommy, that's great. What's your mortgage rate? It was 17%. Okay.
Yeah.
Now think about what's happened over the years, and interest rates in this country have moved lower and lower and lower to where we are right now with the 10-year Treasury bond. I think this morning was at 0.59%. Now, so the investment in fixed income or bonds isn't what it used to be years ago, because there's that inverse relationship. When interest rates go low, the bonds move up in value. When the interest rates move higher, the bonds go lower in value. So when you see interest rates this low in this country, and really it was first quarter of, I think, 2018, where the Federal Reserve, I think it was 2018 or 2019, I get confused now, but the Federal Reserve wanted to move interest rates, or what they would term normalized interest rates. So they were looking at a 10-year Treasury somewhere above 3%. That's what they considered normalizing rates.
Yeah.
And they tried their best to move it higher, and the market punished them, because higher the interest rates, it slows down economic growth. Now, so if 3% is a normalized 10-year, or what the Federal Reserve wanted it to be, and we are now at 0.59%, obviously there's dislocation in the marketplace going on right now. So I don't know if bonds are the place to be, where it used to be the place to be as you came closer to retirement. I use cash now as a way of controlling volatility in a portfolio.
Okay.
Nothing wrong with that. Now, cash in a money market fund, you're not getting much of a return, but you're not losing money either. So it's even though the vehicles that exist today make investing a lot, you become more of a sophisticated investor. The situation we're dealing with right now is so complex that part of it makes it difficult. So I have no problems with people using cash as a way of controlling volatility. And that's unfortunate, but that's just the way it has to be right now.
Well, good. So as we wrap up, this is one question maybe for those out there who, are looking to maybe dip their toes in, or maybe they're not happy with what's going on. Your background on your bio here, you consult on fiduciaries and trustee accounts. I know you manage part of the portfolio for our association. You do corporate retirement plans and endowments and foundations. But for someone who's looking for questions asked their current, financial advisor, or maybe they don't have one and they're looking for one and they reach out to someone locally or they're referred to one? What are some good questions? What's their due diligence to find an investment advisor? So
well, I think what you always have to tell a financial advisor right up front is what you believe your investment time horizon is. Okay. So the minute you walk into that office, you say, look, I'm going to retire in 5 years. I'm going to retire in 10 years. I'm going to retire in 2 years. That's important. All right. We have to understand that. Okay. Because then we would structure portfolios for the individual consistent with those time horizons. So you have to be right up front. You have to basically tell the advisor what your risk tolerance level is and what your time horizon is.
But how do you know the credibility? How do you select the right financial advisor?
Well, not all. Like any industry, right? Not all financial advisors are created equal, right? There is a way that you can look up a financial advisor on the system and see if there have been any complaints, criticisms that were logged in about that particular individual.
Okay.
I am proud to say that, being in the business as long as I've been in the business, I don't have one bad blemish or mark on my record, on my license. So you can check their individual license. And
so to do that due diligence, you say look up on the system. What is there a website, or when you say look up?
There's a website. I think Broker Check. I think there's several websites. You can speak to the individual firm. So let's say if an advisor approaches you from one particular firm, you could call the office manager, the person who's running that office that individual's in, and you can ask them for some information about that particular individual. So there's ways of doing it. And I would recommend to people to do it because, again, like I said, not every financial advisor is created equal. Each one comes with different tools, experiences, backgrounds. I work right now as a member of my team. I have an attorney on my team. All right, a Boston College educated lawyer. Now, I will tell you, he's new to the industry. And he's by no stretch the imagination an investment expert at this time. He will be eventually.
Right.
So
good.
So there's ways of looking into it.
Okay. Well, good. Well, hey, as we wrap up, is there anything else that you feel like we didn't discuss that you want to share, or?
I just want to reiterate. Again, this situation we're dealing with right now, it's far from over. I think everybody has to really sit back. Don't get too caught up in the market gyrations.
Okay.
We are in right now a bear market rally. Technically, is what the name it is. It is, and it's during a bear market rally where the markets kind of start separating themselves from reality.
Okay.
The reality is the virus, we don't have a vaccine yet. The reality is we don't know what the environment's going to look like a month from now or 2 months from now. So just be very careful. Long term, there will be a vaccine. Long term, the world will get back to normal. So again, talking about the investment horizon, if you've got a ways to go before you're going to retire, I don't think you have too much to be concerned with right now. Besides the monumental debt that this country has, the world has, things like that are going to have to be addressed later on.
Good. Well, Jerry, I appreciate it. Good information for everyone to absorb, and I appreciate your time today, calling in, and wish you the best.
Terry, thank you for having me.
Great.
Thoroughly enjoyed it.
Great.
And we'll speak soon. Thank you.
Great. Thanks, Jerry. Have a good day.
You too. Bye.
Bye.